Good evening, all the joinees. Thank you for joining in. Hi, this is Prajakta. I would like to warmly welcome you all on behalf of NGEN Research. So before starting in to the webinar, I'll just introduce our topic for today and we'll let more participants join in. So today we will have a discussion on having a look at the risk parameters that are typically looked at while we are analyzing mutual fund schemes. So for that, our focus will typically revolve around the following key focus areas. So firstly, we will have a look at the value at risk as a parameter for analyzing the downside risk of mutual funds. Next, we will have a look at the capture ratios. So what do I mean by capture ratios? The up capture and the down capture ratios, meaning what is the strength or what is the likelihood of a fund or a portfolio to catch up when the benchmark is going up. That's the benchmark is in a bullish trend. And the down capture will tell you what is the probability or what is the chances of your portfolio or a fund to go along with the benchmark or follow through to the benchmark when the markets are in a bear run. That's typically the bearish market. Next, we will have a look at the risk versus return scatter plot. So we will have a look at which particular fund falls under which quadrant. So we have 4 different quadrants. We will see how each of the funds fall into various quadrants based upon their annualized risk, which is measured by the standard deviation, and of course, their annualized return. Next, we will have an understanding of the drawdowns and the recovery analysis. So drawdowns typically tell us what has been the size of the magnitude of the losses that have been experienced by these funds. And recovery analysis will typically be useful to understand how quickly does that particular fund recover from that loss. Next, we will have a look at the rolling returns and the rolling volatility analysis. And then finally, we will throw the forum open for a Q&A session wherein you can ask your questions by either typing in the chat box or unmuting yourself to speak. So let us now begin. So for the purpose of our webinar, first of all, we will be going on the NGEN Markets landing page. So this is our landing page. And next, we will head over to the funds section. The funds section is the 4th section right here. When you click on funds, you will see that across various categories, across different asset classes. So we have 4 asset classes: equity, debt, hybrid, and others. And all the mutual funds, depending upon their subcategories, are classified into each of these 4 buckets. Okay, now let's for example's sake consider large and mid cap funds as a subcategory and have the analysis of risk parameters of that particular category. So for that, I'll just choose from the equity basket large and mid cap funds. I've chosen this and I click on close. All the large and mid cap funds that are currently trading on Indian equity markets will get listed right here in the fund section. Now let us apply some filters to actually focus on only the risk parameters of these. So first of all, let me exclude all the very, very young funds that are there in this list, because I need to have some data to backtest the performance or the risk parameters against, right? So let me remove all the younger funds. So I'll take in minimum age as 5 years. I'll apply minimum AUM as a criteria of, let's say, 2,000 crore rupees. Every time I put in a parameter, how will I ensure that this takes into effect? For that, every time I put it, I click on apply, right? So I click on, I enter 5 as minimum age, I enter 2,000 AUM as a minimum AUM, and I click on apply. And you will see that the long list of all the large and mid cap funds is now gotten shortened to these many. Now, these are all the funds that actually meet our criteria, the one that we have put here, and then we will do the analysis here. Now, because we are focusing only on the risk parameters of all of these mutual funds, we have a dedicated drop-down option of only risk columns. So currently, you can see all the columns with respect to all of these mutual funds listed. So of course, there are some quite a few not really relevant columns here. So because these are equity-only mutual funds, the net YTM, average maturity, duration, all of these does not make really much of a sense. And then you have to keep on scrolling to actually find out what are the risk relevant parameters. So for that, we have made the job easier. For that, you have to just click on this drop down and choose risk columns only. right? There are a host of options. You can definitely choose equity columns, return columns only, or debt columns, and so on and so forth, depending upon the category that you've chosen. But let's, for an example, because we're considering risk parameters, I'll click on risk columns, and I click outside that. So what really appears here is, first of all the list of funds, their AUM, and their percentage into cash as a holding, as a component in the portfolio holdings, the top 3, top 5, top 10 holdings, and of course this is where other but typical risk ratios. So we have the Sharpe ratio. So what is Sharpe ratio? Sharpe ratio is a parameter, tells us about the risk adjusted returns that are generated by each of these funds. So next is the value at risk as a parameter. But before going ahead, let me just clarify one thing straight away. Whatever parameters that you're seeing here, so the Sharpe ratio, the value at risk, the Sortino ratio, standard deviation, each and everything is from the respective inception dates of each of these funds. So for an example, I can see that the Sharpe ratio of Mirai Asset Emerging Blue Chip is a 0.77. So what is the time period for this? So since the inception of this particular fund, this was the Sharpe ratio that was reported by this particular fund. There is no particular set date here. The ratios that are reported here are since the inception of these funds. Now you can definitely change the start dates and do a fair comparison, but that's possible in the compare section. Let's just focus currently on understanding risk parameters. So first of all, let's understand the value at risk as a parameter. What value at risk as a parameter tells you is, with a 95% confidence interval, what is the 5% chance? How do I come to 5%? That's 100 minus 95. That's 5% chance. What is a 5% chance that if history were to repeat itself, the negative or the worst return that would be generated by these funds would be this much? So in other words, I can say that if history were to repeat, 5% of the times Mirai Asset Emerging Blue Chip Fund would have has already reported a loss of negative 24%. So in other words, if 100 rupees is invested in Mirai Asset Emerging Blue Chip since inception, your capital erosion would be close to 76 rupees. And your capital protection would be 24. Your capital erosion would be 24 rupees, and your capital protection will be 76 rupees. So how do I come? How can we understand this in a little better manner? For that, you will just click on Kotak, one of the mutual funds. So let's consider Kotak Equity Opportunities Funds. We click on it; it opens in a new tab, and we can see that we can now change in the start date to check the value at risk as a parameter, which is a measure of the downside risk. How do you change the start date? Just click on change start date here. And let's consider this for the last 10 years, for an example. So from this drop down, choose 2013, let's say 1st of August, and this analysis runs. Where do you locate historical value at risk? Just scroll down in the fund performance itself. You have a historical value at risk as a parameter here. Now, again, the interpretation of here in this particular fund analytics is in comparison with the benchmark. So going ahead with the same interpretation, if 100 rupees is simultaneously invested in this particular fund as well as the benchmark, what is the benchmark in this case? That's Nifty Large and Mid Cap 250. If 100 rupees is simultaneously invested both in benchmark as well as the fund, your capital protection and what would be your capital erosion? So your capital erosion, your 100 rupees, 23 rupees would have already been a loss in this particular fund. On the other hand, in case of benchmark, the benchmark would have lost 25 rupees out of that 100 rupees, invested, of course, 10 years back. So 1st of August 2013 onwards. Right? As you change the start date, of course, all of these parameters are bound to change, because these ultimately tell you about the downside risk that a particular fund has. Because we are looking at this for a single fund, we are talking about this on a single fund basis. If you look this on a portfolio level, of course, that will tell you about the downside risk of the portfolio. Okay, now let's just, for an example, just quickly change this to a 1-year period and actually check what are the numbers that appear here. So let's, from the drop down, choose 2022, 1st of August. And we can see that the historical value at risk, with a 95% confidence, there's a 5% chance that this Kotak Equity Opportunities Fund will give a loss of 18.32%. On the other hand, the benchmark in the same time duration will give a loss of 18.60%. So that's the value at risk as a parameter. So what this tells you is, what is the value that you've invested in a fund or a benchmark that is at risk? At risk of what? At risk of losing. And that's why I say capital erosion and capital protection.
This is not clear.
Okay. Am I audible? Hello? I hope I am audible.
Yes, yes.
Yeah, okay. So I was just saying that value at risk as a parameter just
It's
tells
breaking.
you. Sir, it is audible to most of the participants. If you could please check your internet connection at your end. Okay, so what I was saying is value at risk as a parameter tells you what is the value that is invested in a fund or a benchmark that is at risk. At risk of what? At risk of losing. So that's the first risk parameter that you should definitely have a look at while choosing mutual funds with respect to their downside risk protection that they offer, right? Next, of course, is the standard deviation. That's right there. So standard deviation is nothing but the volatility of the returns of each of these funds from, of course, inception, and how are they volatile from their average returns. So for that, we have standard deviation as a parameter. And every single time you see a particular parameter, you just click on that, it can get sorted in ascending and descending order. So in this case, we can see that if we consider standard deviations of all of these funds from their inceptions, we can see that Aditya Birla had the highest volatility. That typically means it took in the highest amount of risk under this entire category that we have under selection. Okay, that's the standard deviation as a parameter. Let's now come to the up capture and the down capture ratios. That's the next risk ratio that risk parameter that we must have a look at. So for that, again, I'm going in on a single fund analytics. When I open a single fund analytics, I just have to scroll down. In the fund performance itself, I have the up capture and the down capture ratios. So what up capture and down capture ratio tells you is what is the capture percentage of your particular fund or a portfolio with the benchmark when the benchmark is in a bull run. So up capture tells you how much does your fund go in tandem with the benchmark when it is in the bull run. And why do I call this as a bull run? Because every single time when you click on this I button alongside the up capture ratio, you will only see those particular months when the benchmark was give returns in positive, right? You will not see even a single month when the benchmark gave in negative returns. So for an example, August 22 you see, and after that you directly see October 2022. Why is September 2022 not visible? That's because benchmark in that particular month would have given a negative return. And that's the reason we have not counted that in the up capture ratio. That's typically to say that the benchmark was in a bull run in this particular time period. In the 1 year that we have considered, in these many months, it was up. So now when the benchmark was up in August 2022, the benchmark went up by a 3.68%. On the other hand, the fund that we are considering, that's our asset under consideration, went up by a 2.99%. Okay, so that's definitely lesser than the benchmark in this particular month. Now, if we were to add this cumulatively, we can see that in the last 1 year, the benchmark went up by 50.35%, of course, month on month cumulatively. On the other hand, our fund under consideration went up only by a 46.10%. Now, if we take a ratio of that, 46.10 divided by, of course, 50.35, that comes to a 91.55%. And therefore, the up capture ratio of this particular fund against the benchmark is a 91.55. What is the parallels here is higher the up capture ratio, the better it is. And why do I say that? Because higher the fund is able to outperform the benchmark in a bull run, that's definitely a good thing about that particular fund, right? And therefore, higher the up capture ratio, higher meaning more than 100, that's definitely a good thing that the benchmark or the fund is able to beat the benchmark in a bull run that's going on in the market, right? Similarly, we have down capture ratio. So down capture ratio tells you about what is the percentage of your particular fund or a portfolio in catching up with the benchmark when it is falling. Okay, and therefore we typically call down capture ratio as a bear market or a bear run in the market. And you can typically see that September 2022 benchmark went down by a negative 2.67%. And when the benchmark fell by a negative 2.67%, our fund fell by only negative 2.14%. That's definitely a good thing. Our fund is a little resilient to losses. When the benchmark falls, in this case, December 2022, benchmark went down by almost a negative 3%. Sorry, 2.5%. But the fund went down only by a negative 1.93%. Now, cumulatively, if we have a look at this in the last 1 year, we can see that the benchmark went down by a negative 25.30% in the entire bear run that was going on. However, our fund was pretty resilient to losses, and it managed to go down by only a negative 18.47. So that's definitely a good thing about the fund, right? It definitely falls, but falls by a lesser percentage. And therefore, down capture ratio is 73.02. So the lower the down capture ratio, the good it is, or the better it is. So lower meaning lower than 100. So in this case, it is definitely lower than 100 at 73.02. And we can definitely see that our fund is more resilient to losses. So up capture ratio, higher the better, down capture ratio, lower the better. That's about the capture ratios. Next, let's have a look at the drawdowns analysis of these funds. So first, we'll have a look at individual fund drawdown analysis, and then we will go and compare funds across categories. Let's say for one category we choose, and we will have a look at all the funds from that particular category. So for that, for checking the drawdowns analysis, we have a dedicated drawdowns analysis tab here. When you click on this particular tab, and have a look at these, so you will see that all the top 10 worst drawdowns from whatever start date that you've put. Of course, currently it's 1 year. Let's consider it a 5-year period, and then we'll have a better idea about the drawdowns. So for that, just click on change start date, and I just choose a 5-year ago time period. So that's 31st of July 2018 onwards, and then I click on drawdowns. And what I typically see is that there was a loss of a magnitude of 36% in this particular fund, when the NAV of this particular fund fell from 134.91 to a 86.15. So Kotak Equity Opportunities as a fund, its NAV fell from 134 to 86 rupees. That's exactly a loss of a magnitude of 36% within a matter of just 2 months. 24th January 2020, its NAV was 134. And by 23rd of March 2020, the NAV was at 86. So within 2 months time period, this particular fund fell by a 36%. And after that, okay, this drawdown is fine, but how quickly does it recover? How much time does it take to recover? So that definitely speaks a lot about the strength of the fund to recover from that loss. And that is exactly highlighted here in the days that the fund took to recover from this entire loss of a 36%. Okay, so we can see that it took 169 days after this end date to recover this entire loss of 36%. And it recovered this entire loss when? That was recovered on 13th of November 2020, when the NAV crossed the start NAV. Now, if we were to just hover on the white portions that you can see on this chart, we will definitely be able to see and corroborate whatever we are just building, right? So for an example, I'll just try and hover on 13th of November 2020 on around days, and I can see that the NAV of that particular fund would have already crossed 134.91. So for that, I'll just head over to the chart here, and I'll just locate a 13th November. So it's somewhere here. Yeah. So I can see that, 1 second, yeah. So I have got in a 13th of November, and I can see that the NAV on that particular date was 135.54, right? Which is definitely higher than the start price, the start NAV, which is 134.91. And that's exactly the reason that we have anointed that as the recovery date. Okay, now how is this useful? Typically during volatile times, clients will get jittery. Okay, so now the fund is falling, the markets are falling, the fund is falling. I want to know what should be my exit level. When should I exit? Should I exit or should I not exit? Should I hold on? How much longer should I hold on? This is exactly the time the drawdown analysis and the recovery analysis will help you in advising the clients accordingly. So what you can typically say is, look, historically, this fund has never taken more than half a year or more to recover its entire loss. Okay, so the highest that it has ever taken is 169 days. Okay, that's just about 6 months time period, right? Of course, in working days terms, right? So it has recovered its entire loss in 6 months. So if it's already like just 2 or 3 odd months, just please hold on. And if that's something that the client can do, depending upon his, of course, risk appetite, then if he could just manage to hold on a little longer, this fund will definitely recover its entire loss, considering the history of this particular fund, right? That's where the drawdown and the recovery analysis will come to your rescue. You can also do this for a set of funds. So of course, we have a large and mid cap category. So if you were to just compare the drawdowns analysis and the recovery analysis across all of its peers, all of the Kotak equity opportunities peers, how do you do that? For that, you will have to go back to NGEN Markets. This is our main terminal. We were in the fund section. All you need to do is take all of these funds to the compare section. What is the easiest and the quickest way of doing that? You can just click on this, add top 50 to compare. So up to 50, if there are funds in this particular list, they will immediately get added in the compare section. So we had 16 funds, and all of them have gotten added in the compare section in just a couple of seconds. Okay. Now here is where you head over to the drawdowns tab. And we can do a peer level comparison of the drawdowns and recovery analysis of all the large and mid cap funds. Of course, by all I mean depending upon the criteria that we have set. So we have set a minimum criteria of 5 years old and 2,000 crore as a AUM, right? All of those funds are up here. And let's just take in a common start date. So we had in this case taken 31st of July 2018, 5-year period. Let's just stick to that and do this analysis. So 31st of July 2018. So that's typically 5-year period from now, right? So, and now we can just click on the sizes. So if we were to check amongst all of the peers of Kotak equity opportunities, that is large and mid cap funds, if we sort them on the basis of their sizes, we can see that Franklin India Equity Advantage Fund had a loss of a highest magnitude of 42% loss, right? And this 42% loss happened over a period of 571 days, after which the fund took just 180 days to recover this entire loss. On the other hand, if we were to see and go ahead and recommend only those funds who have typically a history of recovering very, very soon from its drawdowns, that's typically for the risk averse investors or very, very conservative investors, we can definitely choose recovery as an analysis and just click on that to actually sort it as per ascending or descending order. So in this case, we'll of course sort this as per ascending order, lowest to highest. So we can see that Mirai Asset Emerging Equity, Canara Robeco, Tata, Edelweiss, all of these funds definitely have drawdowns, but they recover the quickest from their entire drawdowns. Now you can also do a index level comparison here. So we have all the large and mid cap funds here. If you were to add a large and mid cap index to this, that's very, very possible. So how will that help you? That will help you in presenting to the client, look, index, the large and mid cap index recovers in these many days. And how much time does your fund take to recover? So that's definitely a good thing that you can definitely show. So for adding that particular index, just directly head over to add other items and search indices. Because these are large and mid caps, so just search for a large and mid cap index. So I'm just choosing a Nifty large and mid cap 250 as an index. Once I take this, it will get added as a row item here. And again, I head back to the drawdowns analysis. I need to ensure that the start date is again same, 31st of July, and I click on recovery. That's it. So I can see that Nifty large and mid cap 250 as an index recovers from its loss of a 38% in 165 days. On the other hand, worst loss, of course, this is. On the other hand, all the other funds that are above this particular row actually recover quicker than even the index under consideration. So that's definitely green flag about these funds. So that's how you can definitely explore the drawdowns and the recovery analysis. Let us now move ahead and understand the risk versus return scatter plot of all of these funds. Because we have all of these funds in the list, we directly need to head over to risk versus return as a tab. When we head over to risk versus return, So what we are really achieving, or what we are really trying to do here, is we are categorizing or classifying all of these funds that we have in this main list. So we had 16 funds and one index, of course. So all of these are classified in 4 different quadrants. Okay, what are those 4 quadrants? So low risk, high return, that's on the left hand side, top. Low risk, low return. Next is low risk, high risk, low return. And the last one is high risk, high return. Okay, so what this typically tells you as is these are the 4 quadrants. On the x-axis, we have annualized risk, which is the standard deviation. So the more the fund gets plotted on the right hand side, that typically means the higher is the level of risk that is being taken by this fund. So for an example, in this case, LIC MF large and mid cap fund has gotten plotted on the left hand side, versus that this one, Nippon India Vision, that has gotten plotted on the right hand side. So that typically means that Nippon takes a higher level of risk as compared to LIC. Okay, so the more right hand side it gets plotted, the higher is the level of risk that is taken by this fund. On the other hand, on the y axis, we have annualized return. What do I mean by annualized return is, I mean, how is that significant here? So any fund that gets plotted on the upper side of this particular quadrant, that typically means it generates the highest return, right? And the lower it gets plotted, at that is towards the lower return range. Right now, we have a show labels on chart toggle button. So if there's a lot of crowd in this particular chart, you can just untick it, similar to what I had just done. Alternatively, you can just click on this and you will have a look at the names of the funds here as well. Okay, so in this case, we can just do a comparison between, let's say, a Canara, HDFC, and a Aditya Birla. So what we typically see is Aditya Birla takes in a higher level of risk. Why do I say that? That is because it has gotten plotted on the right hand side as compared to a HDFC. Okay, with taking higher level of risk, it generates lower return as compared to HDFC as well. So in this case, we can see that Aditya Birla takes in a risk of 17%, gives them a return of 11%. On the other hand, HDFC with a lesser risk generates a little better return. That's because it has gotten plotted above Aditya Birla. And that's how you can actually eliminate this particular fund from your further whitelisting when you're actually choosing top 5 or top 10 funds from each of the categories, right? You can actively use this as a parameter. Now, this can also be used in one other way. As you currently saw that the time period under consideration is 2015 to 2023. And we can see that, okay, HDFC is here, Aditya Birla is somewhere here, and Nippon India Vision is on the extreme right-hand side, which is highest risk, lowest return. You can just change the start and end date, and you can actually see how does this risk versus return classification dynamically change. So let's consider just 1 year time period. Let's just say 1st of August 2022 to a 3rd of August 2023, in just a 1 year time period. How has this classification changed? So where is Nippon now? So Nippon is somewhere here, right? So it has definitely improved its return because it has gotten plotted on the upper quadrant. On the other hand, HDFC large and mid cap, this particular fund has gotten classified in the uppermost quadrant. That typically means that with the highest level of risk, it generates the highest level of return, right? So that's how you can dynamically see, as you change the start and end dates, how does this risk and return classification of each of these funds changes. Next, let's move over and understand the rolling analysis. Rolling analysis, for understanding rolling analysis in detail, comparing it across funds. Of course, we have this rolling analysis tab. For that, just click on rolling analysis, and you will have you will get to have a look at the rolling analysis of all the funds that we have in this list. So what rolling analysis tells you is what is the consistency of a particular set of funds to generate return in that particular return range. So for that, we have multiple parameters here. Firstly, the first parameter is the rolling window. Rolling window, nothing but means a holding period. So let's say you want to consider a holding period of 1 year. That's equivalent to 260 working days. Everywhere on this platform, working days are 260. That means 1 year equivalent. So we are considering rolling window of 1 year. That's nothing but holding period is 1 year. Holding period is 1 year in what time period? So then we can specify the time period by choosing the start and end dates. So now let's consider again a 5-year time period. So 2018 of August, 1st of August 2018. to a 3rd of August 2023, and we click on run. So what this typically means, if any particular investor holds in any of these funds for a 1 year time period, any period of time, that year, 1 year could be any time between 1st of August 2018 to a 3rd of August 2023. So in this 5-year time horizon, if a particular investor invests for a 1 year period in, let's say for an example, Mirai Asset Emerging Blue Chip, what are the average returns that he can expect? So the average return that he can expect, or he has already gotten, this is historical data, of course. So he has already gotten is 18.07%. On the other hand, the highest that the investor would have gotten in a 1 year time period, that's 1 year holding period in this particular fund, that's Mirai Asset Emerging Blue Chip, is a 75.19%. So that means the investor would have been luckiest if he would have invested in exactly 260 days prior to this particular period, when exactly that time he would have generated the highest amount of return. On the other hand, the investor would have been unluckiest if he would have specifically invested in this particular time period when he would have gotten the lowest return of a negative 28.98. And now we consider the swing. That means from high to low, what is the particular range or the swing of this particular fund? So that's 104%. How have you arrived at this? So modular difference between high and low, right? So it can go as high as 75%, but it can fall as low as negative 28.98%. And therefore that the swing or the range is 104.17%. Now, again, a next important parameter for actually deciding on the risk, or typically for the risk averse investors, is the percentage positive that we have really mentioned here. So what this typically means is, in 1 year holding period for any particular of time period between 5 years, so 2018 to 2023, Mirai Asset Emerging Blue Chip as a fund backtests in the positive quadrant. What do I mean by positive quadrant? Returns more than 0%. Okay, that's positive quadrant. It generates returns more than 0% in positive, of course, 80% of the times. That means remaining 20%, it generates negative returns. Right now, you can also sort this on the basis of a positive percentage. And if a particular investor is typically conservative and risk averse, you can definitely go ahead and prioritize positive percentage as the number one criteria. So in this case, we can see that the holding period is 1 year. In the time period of 5 years horizon, Tata Large and Mid Cap actually generates positive returns. That's returns above 0%, 90% of the times. That's definitely a good thing about this fund. And you can definitely have a look at the other funds. So Kotak Equity Opportunities definitely comes a close second with a 88% times this particular fund generates return above 0%, right? That's the percentage positive. Next, we have these rolling return ranges. How are they typically useful? So for an example, if a client comes to you, okay, and says, okay, fine, whatever funds you're trying to recommend me or trying to make me invest in, I want the returns or the target return range of mine with my investments is to generate a return between, let's say, moderate 5%, 5.5% to as high as a hypothetical high as a 50%. So for that, how will you tell that which of these funds or the funds that you're trying to recommend actually generate or meet his target return range? So for that, that's typically where you should come to rolling returns distribution. In any of these buckets, you can see 5 buckets here, 1, 2, 3, 4, and 5. In any of these 5 buckets, just put in the target return range of your client. So as we just discussed, the target return range of the hypothetical client that we were just talking about is a 5.5% to, let's say, a hypothetical high of a 50%. Okay. Put in these parameters and just click outside. And you will actually know what is the probability of each of these funds to generate return in this target return range. So we can see that Tata Large and Mid Cap generates returns between 5.5 to 50%, 77% of the times. That means this particular fund meets the client's expectation or the client's target return range 77% of the times. That's definitely a good thing, right? It meets it 77% of the times. On the other hand, in this case, you see that Franklin India Equity Advantage, you would typically not try and go ahead by recommending this fund, is because it meets the client's target return range only 38% of the times. That is to say that only 38% of the times Franklin India, considering 1 year holding period, will generate return between 5.5 to a 50%. Okay, so that's how you can use rolling returns distribution. And of course, this analysis is on a comparative level. If you want to do this on a single fund, that's available as well. How will you do a single fund rolling analysis? Again, just click on this particular fund. It will get open in a new tab. And we have a dedicated rolling analysis tab here as well. When you click on this, in compare section, you can typically check for holding periods one at a time. Okay, so here you could check 260 days, that's 1 year equivalent. You want to check for 2 years, you'll have to change this. You'll have to change this to 520 days. And of course, a 2-year rolling analysis will open up. But we have made that specific parameter easier when you load a single fund. So when you load a single fund analytics, we have given a three bucket, 3 different time periods that you can actually customize and choose from. Okay, let's say you want to show a rolling analysis for a 1 year, let's say a 3-year and a 5-year directly, right? So then just 260 is 1 year equivalent, 3 years is 780. Just multiply 260 by 3, that's 780 days. And of course, a 5-year. So 5 years, just 1,300. That's 260 multiplied by 5. And just choose this as annualized and click on run. And on one single chart, you can actually highlight, look, if the holding period is 1 year, these are the average returns that you can expect from your investment. Okay, so if you hold this particular investment for a 1 year time period, from any particular time, that's 2010 onwards till 2023, average returns that you could get is a 14.62%. Any 1 year time period. Holding period is 1 year. Now, as the holding period increases, you will see that the lowest that this fund has ever generated with a 1 year holding, it generates a negative of a negative 28.29. As the holding period increases from a 1 year to a 3-year period, the lowest that this fund has ever gone substantially reduces to just a negative 3.80%. So that's exactly how you can actually validate your hypothesis that, okay, as the more you stay invested in a mutual fund portfolio, the lesser is your likelihood of losing capital, right? And making money, right? So that's typically what you can highlight here. So as the 1 year, 3-year, and a 5-year. So when it comes to 5-year, the lowest that this fund has ever gone is again a positive 2.11. Okay, that's something that can definitely be highlighted using this rolling analysis. Now, similar to what we did for an individual fund, this can also be done on a portfolio level. The only difference is, you just have to go over to the portfolio section, load in any particular portfolio, and actually click on run, and you will definitely be able to see the rolling analysis, the drawdowns analysis on a portfolio level as well. So the functionalities or the logic works the same. It's just that in today's webinar, we saw it on a single fund or a list of funds, the basically peers of that particular fund. You want to do this for a portfolio, just head over to the portfolio section. You want to have a look at the up capture, down capture ratios. You can definitely have a look at it here. The rolling analysis are definitely available here. And of course, the drawdowns are available here. So this is about the entire portfolio as a whole, right? This is available in the entire portfolio level. That's typically it from my side towards the topic specific webinar. We can now throw the forum open for a Q&A session, wherein you can just ask your questions by either unmuting yourself or typing it in the chat box. Thank you. So we have a question in the chat box which says, what weightage as a percentage for risk parameters along with return parameters we should give in selecting a fund? Okay, so that's there's no one size fits all answer to this, because depending upon the client's risk appetite or the client's objective, that will definitely vary. Okay, so as I was just mentioning, if it's a risk averse client or a conservative client, you should definitely give a substantial percentage of consideration to the risk parameters in the selection of funds or selection of portfolios or building portfolios for the client. On the other hand, if it's a risk-seeking client, Okay, he definitely does not mind taking in slightly more risk, but if he's getting more returns, he is okay with taking that amount of risk. Then, of course, consideration to risk parameters will definitely reduce for that particular client's, building a portfolio for that particular client. So that is typically subjective with respect to the client's objectives or your client's requirements their risk profile, basically. That is honestly a very subjective call.
Hello.
Yes.
Can you hear me?
Hello. Yes, I can hear you.
Hello. पोर्टफोलियो कंपेयर में जो हम रिकमेंड करते हैं और क्लाइंट का पोर्टफोलियो वो दोनों कंपेयर करते हैं, तो उसमें अमाउंट का ऑप्शन आप नहीं होता तो वो सजेस्ट होता है।
सर अमाउंट का ऑप्शन है वहां पे। आई विल जस्ट शो इट
कंपेयर नहीं, वो पोर्टफोलियो में क्लाइंट का पोर्टफोलियो करो तो अमाउंट डालो, तो फॉर एग्जांपल 10 लाख डाले तो इसकी वैल्यू इतनी है। हाँ, बट कंपेयर सेक्शन में दोनों पोर्टफोलियो कंपेयर करते हैं तब वो ऑप्शन नहीं आता है।
अच्छा, मतलब आप एक मिनट, तो दोनों आप पोर्टफोलियो कंपेयर यहाँ पे कर रहे हो, राइट?
यस,
ऐसे
क्लाइंट का और हमारा।
हाँ, बराबर। तो फॉर एन एग्जांपल, क्लाइंट का एक एग्जिस्टिंग पोर्टफोलियो है, तो मैं एक एग्जिस्टिंग क्लाइंट पोर्टफोलियो यहाँ पे लोड कर लेती हूँ। ऑन द अदर हैंड, एक मॉडल पोर्टफोलियो जो आप सजेस्ट कर रहे हो क्लाइंट को, तो दैट इज योर ऑन द राइट हैंड साइड। एक बार आपने ये दोनों पोर्टफोलियोज लोड कर लिए ना, ये पूरा ऑफ कोर्स एनालिसिस आ जाएगा। और उसके बाद में आपको यहाँ पे क्लिक करना है क्रिएट पीडीएफ। व्हेन यू क्लिक ऑन क्रिएट पीडीएफ, अगर आप डायरेक्टली स्टैंडर्ड पीडीएफ क्लिक करोगे तो परसेंटेज में आएगा, लेकिन अगर आप यहाँ पे कैपिटल डालोगे, लेट्स से अज्यूमिंग ये क्लाइंट का 1 करोड़ रुपीज है AUM, राइट, इन दिस पर्टिकुलर पोर्टफोलियो, एंड आपको एनालिसिस बताना है कि व्हाट इज द प्रपोजल, एक्शनेबल प्लान, तो आप सिर्फ अमाउंट डालिए एंड क्लिक ऑन गो। व्हेन यू डू दैट, एक अमाउंट बेस्ड पीडीएफ डाउनलोड हो जाएगा। ऑफ कोर्स ये एनालिसिस तो परसेंटेज में ही होगा। द लास्ट पेज इज व्हाट इज गोइंग टू बी द गेम चेंजर। यहाँ पे देखिए, ये अमाउंट में आ जाएगा। दिस इज द एग्जिस्टिंग कंपोजिशन ऑफ द पोर्टफोलियो और ये टारगेट कंपोजिशन टू अल्टीमेटली अचीव, दिस इज द एक्शन प्लान।
टोटल नहीं आता, टोटल वैल्यू कितनी होती?
सॉरी,
टोटल फॉर एग्जांपल 1 करोड़ क्लाइंट का पोर्टफोलियो है और मॉडल पोर्टफोलियो का 1 करोड़ इन्वेस्टमेंट वैल्यू। हाँ, 5 इयर्स बैक डेटा हमने दिया था, आज की तारीख में कितनी वैल्यू होती है?
ओके, लाइक दैट। ओके, गॉट इट।
जो पोर्टफोलियो में आती है।
हाँ, समझ गई मैं। सो यहाँ पे बोल रहे हो आप, सो ऐसे जो आता है वो आपको चाहिए। हाँ, समझ गए। ओके, गॉट इट। ओके, सो ये बोल रहे हो ना आप, वैल्यू 1 करोड़ एंड दैट बिकम्स, ओके, गॉट इट। नो,
वो कंपेयर में नहीं आता।
समझ गई। आई विल जस्ट नोट दिस डाउन एज अ फीडबैक एंड वी कैन डेफिनेटली वर्क ऑन इंक्लूडिंग दैट एज वेल इन द फर्दर डेवलपमेंटल साइकिल्स। ठीक है।
और वो कंपेयर पोर्टफोलियो में थोड़ा लेमन लैंग्वेज करो, बहुत टेक्निकल हो जाता है।
हाँ,
तो वो एक सजेशन है।
कौन सा सर? कंपेयर पोर्टफोलियोज?
ये सब कंपेयर पोर्टफोलियो में चार्ट वो ये सब आते हैं ज्यादा, तो थोड़ा टेक्निकल ज्यादा होता है। थोड़ा ऐसा कुछ आप क्रिएट करो कि क्लाइंट इजीली समझ सके, थोड़ा लेमन लैंग्वेज।
ओके, ठीक है। आई विल जस्ट आस्क आवर ट्रेनिंग टीम टू एक्चुअली गेट इन टच विथ यू। अगर आपको कुछ स्पेसिफिक रिलेटेड सेक्शन स्पेसिफिक क्वेरी है तो हम डेफिनेटली एक्सप्लेन करेंगे आपको डिटेल में। बट मतलब हाँ, ये जो एनालिसिस है ये थोड़ा स्टेटिस्टिकल एनालिसिस डेफिनेटली हो जाता है विद रिस्पेक्ट टू मल्टीपल ईयर रिटर्न्स एंड उसका कंपैरिजन। बट अल्टीमेटली व्हेन यू वो शोकेस करोगे क्लाइंट के साथ, डेफिनेटली दैट विल बी good thing for the client. But yes, I will definitely take this down as a feedback. If we can simplify this, we'll definitely work on that.
Amount का suggestion करें।
Okay.
Well.
Okay, thank you. Noted down, sir. There is another question in the chat box which says, can we do leading analysis here, as relying only on historical data doesn't always backtest? Yeah, I mean, you're right with respect to when you're saying that relying only on historical is not, does not really speak about the future. But unfortunately, that is all we can, that we all can rely on, because unfortunately, there are no leading parameters anywhere on this platform. Everything and anything that you see on this platform is historical basis only. Because there's some amount of variability in or a lesser amount of predictability in whatever future parameters that you might look at. So unfortunately, I mean, there are only historical parameters that are available here and no leading parameters. Any more questions? Please ask.
Yeah, hi Prajakta.
Hello.
Am I audible?
Yes, you are.
Yeah, so you showed us a comparison of this high risk, low return, and low risk, high return of the existing portfolio MFs, right?
Correct.
So, is there a way to check all the high risk, high returns funds at once, whether it be related to equity or debt, but all together at once on the same chart?
I mean, you can definitely do that, but I mean, it will get too crowded. So all you need to do is go to the compare section, or alternately in the fund section. Let's say you want to, add 3-4 categories, right? You just go on adding whatever categories you want, basis their risk versus returns scatter plot. So let's say you want to have all of these categories. You specify whatever minimum parameters that you have. Once you've set them, just take them to the compare section. And across different categories, all the funds have gotten added here. Of course, up to 50 you can take in one single go, and then you can just click on risk versus return, right?
So we can take only 50 at once, right?
Single, yeah, in one single click you can take 50. But I mean, if there are more, I mean, it honestly, if it's more than 50, it'll get a little difficult to even see. I mean, visually it will be a little difficult to interpret, but at single point of time, I mean, up to 50 you can add in one single go from the funds. There's no particular limit in adding as many as funds you want in the compare section. There's no limit like that. I mean, you can take as high as 200, 150, 200 funds, right? That's not a problem. It's just that how crowded this chart will get. That's the only issue, right?
Okay.
Yeah.
So can you see this?
Yeah. So you can typically see, of course, let's consider a 5-year time period. So one second. And I click on go, I can see that, okay, quant small cap. So as is typically expected, all the small caps typically will lie on the, high risk side. And you can definitely zoom in here. So that's definitely possible, right? So you can zoom in, zoom out. That's possible.
All right. Yeah, one more question.
Yes.
So, when I check the portfolios of my client, it doesn't usually happen that we invest in all the funds on the same day. So we might, take up like Mirai Asset in 2021 or go for Nippon Small Cap in 2022 and some
Correct.
others in 2023. So, is there a way to check these clients' entire stats, differentiating on the date on the same sheet? Because I've been struggling quite a bit with my relationship manager on the same question since past week now.
Okay, so on this platform, we do not capture transactions. So whatever portfolios that you see here, portfolio analytics that you see, is a historical back testing based upon the current holdings in the client's portfolio, irrespective of the fact when they were, bought or sold. Not typically sold, because ultimately, if they are sold, they will not be a part of this particular portfolio as on a particular date.
Yes.
Right. So we do not capture transactions. This is a hypothetical historical backtest. Depending upon what are the current holdings in the portfolio, right? Transactions, our platform does not capture.
Okay. All right. Also, I was checking some of the fact sheets of these mutual funds in the past month. So I can
Yes.
see that on the 1st of August, the fact sheets of June of these funds were available and not of July. So the stats that you guys show here on NGEN were a bit different than those on the fact sheets. So how do you capture these figures?
Yeah, got it. So so typically you will see that as of now, the holdings are updated as of 30th of June 2023. Okay, our daily or the monthly cycle that runs for updating holdings, that runs between 8th and 13th of the next month. So between 8th and 13th of August, we will have the cycle running for 31st of July 2023 holdings. Okay, so typically that is also available in the fund section. In the holding analysis, you will see, yeah, as of now, it's 30th of June 2023 only. And that's the reason any fund particular fact sheet that you download will show it, the holding specifically, as of 30th of June. Our cycle runs from 8th of next month to 13th of that month. So that is typically when you will see the holdings getting updated of 31st of July 2023.
So you guys will be able to show the figures till 13th July, right? Why is it still 13th June?
Sorry?
What you just said was that you guys capture the figures from 3rd to 30th, right? Of every month.
8th of,
Sorry,
so
yes,
basically,
8th to 13th of every month.
Yeah,
So
yeah,
you
yeah.
can see the figures are updated as of 30th June. Why is it not captured in 13th July? Because we are in the month of August now.
Yeah, what fact sheet are you referring to? Can you, I'll just get that checked. I mean, I'll just ask our team, can you please name that fund?
I don't have the details with me right now, but yes, I can mail to you guys on your
Sure.
email.
Support. Yes, please do that. We'll get that checked. Yeah.
Okay, Prajakti.
Typically,
That's
if
it.
it's
Thank you.
typically if it's a debt fund, because debt funds have been mandated to come up with these holdings analysis every 15 days. Okay, and that's the reason you can it could be possible that you're seeing this for 15th July or as of 30th July. One second, let me just load in a corporate bond, maybe. One second. Okay, that's a Nippon India corporate bond fund, and I can see, one second. Yeah. Because these, by SEBI, these funds, typically all the debt funds have been mandated or, asked to report their holdings 15 months basis, fortnightly basis. And that's the reason for all of these debt category funds, you will see the update as of 15th of July, 2023, right? For all the equity, that happens monthly basis only. For it could be a debt fund. If was it a debt fund?
Yes, I think it was a debt fund.
That could be most likely the reason, because as per SEBI mandate, they are required to disclose all of their holdings as of 15th of June. So basically fortnightly. Yeah, that could be the reason.
One more question. I was not able to find a fund on NGEN. So can I mail it? Can you please check it?
Yeah, please.
So that was Bandhan GSEC fund, constant maturity plan.
One second.
That's a debt. Bandhan
GSEC.
Yes, constant maturity plan. A direct plan.
Was this the one? Constant?
No, I can see this one. So if you can check, it is Bandhan GSEC investment plan. I'm looking for constant maturity plan.
Okay. I cannot see it right now. But definitely, we'll just get this checked. Yeah, if you could just drop in a one-liner on our support, I will just follow it up on that email. Yeah, support@NGENresearch.com. We'll just have it checked.
Sure, I'll do that.
Yeah? Okay.
Thank you.
Thank you. So if there are no more questions, we can wrap up the session here. So thank you everyone for joining in. I would really like to thank you for giving your time. You can definitely check the recordings of all of these sessions on our YouTube channel, which is uploaded every single week. So you will of course see the recording of this particular webinar in the next coming week. We have a dedicated playlist created for all the webinars, and you will see all the webinar videos updating in this particular playlist. So thank you so much for joining in. Have a great weekend ahead. Thank you.